投資股票最困難就係揾到啱嘅買賣時機，不過呢個問題對於 Mark Minervini 嚟講呢，根本就係小菜一碟。佢曾經喺1997年嘅一個美國投資公開賽裏邊獲得冠軍啊，而呢一個比賽裏邊呢，佢只係單靠投資股票就已經擊敗咗好多交易期貨同埋期權嘅操盤手，一年內呢獲利155%，咁同第二名嘅回報比較仲要高出接近1倍啊！如果你唔認識佢嘅話呢，你絕對有可能會認為呢一個比賽嘅回報只係幸運嘅結果。咁所以時間呢就係最好嘅證明啦。佢曾經提及過呢，喺過去30幾年嘅交易經驗裏邊啊，好多年嘅回報都係以倍數嚟計算嘅。如果真係好彩嘅話呢，係冇可能長期都有賺錢嘅結果。嗱，有見及此呢，我就認為佢嘅交易方法咧，必定隱藏住一啲嘅秘訣，可以大幅度提升我哋嘅交易技術。所以我就從網上咧去揾到一個佢解說佢嘅交易方法嘅影片，希望咧從中得到一啲嘅啟發。以下咧就係 Mark 嘅解說啦。
Now we want to talk about drawdowns because when it's all said and done, I mean I had clients. I'm not going to mention any names, but we had one client. They managed a hedge fund, and they literally were up over 1,000%. The hedge fund was up over 1,000%. A year and a half later, they were down over 99%. And the funny part was they sent out a letter to their investors and they said that they felt they could get it all back within 12 months, which was extremely comical. They eventually, of course, went out of business, but they were hugely leveraged and in Qualcomm and some of these names that were the big high flying, and they were leveraged. But drawdowns are really, and if there's anything that, if I look back at my career and my performance in the market, I'm proud of the fact that I had a lot of big years and I've gotten a lot of those triple-digit years, but it would be meaningless if I gave it all back in the bear markets. What I'm really proud of is that 88% of my months have been positive. And almost all my quarters, I've only had a few quarters in several decades. In several decades, I've only had a few quarters that were even negative, and they were all single digit. So this has really been the key to my success. And I'm going to go over with the 4 principles of how I'm achieving that. Dave, as far as drawdowns are concerned, I know you had early on, you had where you were up big, and then you gave it back, and that was sort of a big lesson for you. Any words of advice as far as drawdowns are concerned, and your own story, what you learned from it, and
yeah, you should use. We can go through this. Teach you all these rules, and you can read all the books that Mark's put out and Bill's put out. But a lot of this is learning from yourself. And so when you do have a drawdown and you do get hit, the market, it takes money away from you. Don't get so down on yourself, but take it as a learning experience. Because what I did is when I first started out, I took an account and I doubled the account, and then I lost it all back and more. I mean, I went from 30 to 60,000, and I came down into the low 20s. And I spent an entire weekend going through every mistake that I had made for the last year. And I learned from those mistakes. And I said, I'm going to get so disciplined, I'm only going to look for this exact setup. And when I got down to that point and got that determined to only look for that setup, that's when my performance started taking off. But it all started from studying my mistakes and learning from what I had done.
Dave, are you ever buying a stock that's plummeting?
Oh, no. I'm usually always buying a stock that's going up. There's no reason to buy a stock that's in a downtrend or a stock that's getting hit extremely hard, because there's a reason why they're getting hit like that. Either the bad news has come out, earnings have slowed down, or sales have slowed, or something negative is happening. I am always buying a stock that's in an uptrend that's maybe coming out of a base after
you want
consolidation.
All the direction going in your direction. So rule number 1 is to always trade directionally. And when I say directionally, that's the trend, the long-term trend, the intermediate-term trend, the short-term trend, and the action that's happening that day as the stock is moving. You want everything to be put all the trends in your favor. And that's what I call stacking probabilities. You want to stack probabilities. When you start stacking probabilities, it becomes multiplication, it's not addition. It's not 1 + 1 + 1 probability equals 3 or 4. It's a multiple of that. When you start putting all these things together, they give you a much higher probability. I'm always buying in the direction of a trade there. Okay, let's talk about another principle of minimizing drawdowns. So another thing that I do that I really feel like this is one of the absolute most important, and the things that have been the principle that has been most responsible for me not having big drawdowns, and that is that I always expose progressively. And what that means is that I never just plunge into the market on my opinion. Even if things start looking really good and everything starts taking off, I'm usually just putting a toe in the water, and I'm going to take a few trades, and say I'm in 100% cash and we're in a correction. Some stocks start setting up, they start emerging. I'll usually, we're in a correction. Some stocks start setting up, they start emerging. I'll usually go to about 25% invested. If things are really looking good, I might go to 50. But usually my first toe in the water is 25% invested, and I might buy 2 stocks at 10 or 12% positions, or maybe 4 or 5 stocks at 5% positions, just a toe in the water. If things start working, I move it up to 50 pretty quickly, and if they work from there, I try to go to 100 as fast as possible. But I'm always pyramiding on my success. Now, let me explain why this is important. And this is a key sentence, all right, that you should always remember. If you build into your exposure when you're trading well, when things are going well, and you scale back when things aren't going well, you're going to get whipped around every now and then. You will zag against the zig, if you will, but what's going to happen is when you finally get into a bull market or a bear market, you're going to be trading at your largest when you're trading your best, and you're going to be trading your smallest when you're trading your worst. So it will protect you in the bear markets, and it will make sure that you're invested heavily in the bull markets. And that's all the noise in between is going to be there, but this is where it really all comes down to, is when you have to make the money in the bull market and you have to keep it during the bear markets. Now, very simply, let's just use a full position at 25%. We'll call a full position 25%. So a quarter position will be 6.25%, right? So let's say I go in there, I risk $500, and I'm trying to, be a 2-to-1 trader. So we'll just use, once you get a 2-to-1 gain, you're selling it. So I take $1,000 profit. Well, now I can take that $1,000 and I can bump my position size up, and I can risk $1,000 and go to a 12.5% position. Now, let's say I get another profit. I can now move that and risk $2,000. So maybe I lose on there. I still have $1,000 left over. That's in my P&L. That can now finance a half position, and I can go through this whole cycle and not lose anything. Okay. Now, if things are working and I start pyramiding at some, you may say, well, who the hell wants to break even, right? Okay, but if things are working and I keep pyramiding and things work out and I don't get stopped out of these names, now I've got myself at a nice invested position, and I've really positioned myself well. But if things turn around on me, I'm out of the market. So just bending with the market, I know, Dave, I know that, you're a toe in the water guy too. You're not going to just jump in, and any we all have our own sort of little ways we do it and rules that we do. I know, you and I are both, more conservative than we used to be. We're not putting our whole account in one name anymore. Any rules for, or guidelines for,
Yeah, I usually, I determine, now I usually go, I start with I have 10 stocks in my portfolio, and when I'm buying a position, a new position, that's going to be 10% of my portfolio, I usually start at a 5% position. I just figure what I'm going to put into that count, and I start with a 5% position. And if the stock starts working out pretty quickly, then I move that up to 10%. Sometimes it might be the same day, but lots of times it's the following day or the third day. And so I constantly just adding money to positions that are already starting to work for me. If that 5% position starts down and starts coming off, I'm not going to be adding any money to it until I can see it's holding and starting to go back up through new highs. So it's going back to that principle of always adding to winning positions and not adding to losing positions. And then as time goes on, if I have a nice 10% position and that stock makes a nice move and it's, you know, I'm up 20 or 30% and it builds a whole new base, well, I might even double the position at that point, because if you can get one or two great stocks in a year and you add to them on progressive basis, that's where you're going to make up for all the small losses you might take and have great gains over a year period of time in your account.
Yeah, and this really goes right, you know, and flies in the face of what I see a lot of people. They tend to revenge trade. So if they start to have losing trades, they'll ramp up their exposure and try to get it back quickly and start doubling up, and that's how you blow yourself up. You've got to be humble. All right, I've been doing this now for over 3.5 decades. David's been doing it for 4 decades, and we still have to cut our losses and admit when we're wrong. You know, we haven't gotten so good where we're not going to have losses, and you're not going to either. So you have to realize that, you know, revenge trading and trying to make it up and going in there, you've got to bend. And sometimes, you know, I get people like they'll send us emails and messages on Twitter and say, you know, oh, I scaled up and then everything started getting hit. Then I scaled down and everything started taking off and it's not working. Okay, but again, that's the noise in between, but that's the price. It's like an insurance policy. Okay, that's the insurance. That's the small price that you pay to keep yourself in the markets, the good markets, and heavily invested, and out of the markets that are poor. Just a quick note too: if you're looking at, you know, some of these charts and they have low prices, some of them might even show, you know, it's pennies. It's just, they're split adjusted, so they're not the actual price. I'm not buying, you know, stocks that are trading at 20 cents or even usually $10. It's usually going to be you know, higher priced names. So the next thing that I do, and that really helps me with my drawdowns, is that I protect my break-even point as quickly as possible. Now, there's a little bit of latitude there, or that's you know, that's a relative term. The key is not to choke the trade-off. You want to protect your break-even point as quickly as you can, but give the stock enough room to fluctuate normally. And that's what takes time to learn on what is a normal action and what is abnormal action. When you know what's normal, then you know what's abnormal, and you know when you have to get out of the trade. So what I normally do is, if the stock is, you know, it moves up from, let me see if we have a chart here. Yeah. Okay. So here's an example of a recent trade not too long ago. In January, yeah, it started rolling over. The market went into a correction here, going into February, and this stock, you know, went right in as the market started to top there. But I bought it coming out right here. You can see a little base coming out. Stock ran up, and because the market got a little heavy, I actually sold a little up here, and I cushioned myself a little bit. And then it came in, and I got knocked out at break even right here. And then of course the stock went a lot lower. The market corrected. Now that's how it happens sometimes. Sometimes I won't even sell any, as it turns up. And what I normally do is, if the stock goes to its first pullback and then goes into new high ground, I'll then move my stop to break even. And I usually don't move my stop to break even. I stick to my original stop until the stock goes through a first natural reaction and then gets into new high ground from there, and then the break even point becomes a critical level that I'm usually protecting. And then from there, let me see if we have another example. Okay, so here's another example of, you know, where sometimes, you know, it hoses you. Here's a perfect example. I bought this stock back here in June, and it came out of a nice big base here, nice tight pivot point, came out really well, and you can see it had a little natural reaction, then went back into new high ground. So that's my cue to move my, and you know what, I should be using my, I'm sorry, I should be using a pointer. There we go. Here we go. Sorry about that. I'm thinking the whole time you're seeing my pointer. So right here, we break out. We come through a little natural reaction here, and then we get into new high ground. So then I move my stop up to break even. Unfortunately, stock came back really quick, knocked me out, and then ended up taking off. Now, that happens. That, like I said, that's the price that I have to pay. Sometimes it's going to happen. There's other times I move my stop to break even, keeps going. I ratchet it up, and I end up taking advantage of a big gain. Again, it's all about what you do over time and what happens on average, not any one particular trade. If you're going to Monday morning quarterback and say, oh, well, I should never do that again, that's like saying, you had aces, and which is the best starting hand in poker, and you lost with them, so you say, I'm never going to play aces again. Well, that wouldn't be too smart. That's the best starting hand you can have. Or you win with a pair of threes, and then you think I should always play a pair of threes. You don't judge. Stock trading is about probabilities. You have to think over the long term. You're going to make hundreds of trades, thousands of trades. You have to be able to do something over and over.
Mark, if you go back to that, one thing, and I do this a lot. Let's say you did buy it on the breakout, and the stock pulled back, and then you got sold out, and then it came back up, and it set up again. Well, this stock gapped, but if this stock started breaking out and it wasn't too far extended and it came through that 48 area, you can buy it back. That's where your ego, you have to throw your ego into the trash can every time you step into the market, because just because you lost money on it, you step into the market, because just because you lost money on it, you took a small loss, doesn't mean that you can't buy it back again. And sometimes I've lost money 2 or 3 times in a stock, and finally I buy it again, and then the thing just takes off and goes. So that's where the ego, or you have to just dismiss it and look at every situation.
And that's getting into more advanced techniques of that's what we call a reset. There's a pivot reset, a pivot failure reset, a base failure reset. These are things, of course, that we'd have to spend a lot more time on. But absolutely, David is 100% correct. You don't think that the stock has it out for me, or that it's bad. This stock's bad luck. If it sets up again, the fundamentals are there. Just because this stock stopped me out, it's highly unlikely that the fundamentals change that dramatically in just a few days, unless this was on some key report that had some horrible news. But it wasn't at the time. So you could still have all the fundamentals there. Let me just move on here. I know I'm kind of pushing a little bit quick here now because we're running tight on time. Let's see. So here's another one. This USAK. It's a trucking company. Real tight. I bought it thinking, as for a trade here. It had a nice. It came out of the gate pretty nice for a few days, came back, and a lot of times what I'll do is I'll either sell some of it as it runs up quick and then move my stop to break even, or what I'll do is I'll move my stop to break even on half my position, and then I'll maintain my stop on my original stop on my other half. And that's what happened this time, where it came back, it knocked me out of half, but then it was able to move up here. I got a nice gap on it, it took off, and I sold it into that rally and had myself a little profit on it. Finally, let's talk about selling into strength. And again, this is really the hallmark of a professional, is to sell. Amateurs get all enamored when the stock's going up, and they start having all kinds of illusions that the thing's going to keep going forever. And then because a lot of times the momentum is so great, they'll sell it, and then it'll go higher, and they'll think, that was a dumb thing to do. But again, you can't Monday morning quarterback. You're not going to get the high. The chances of you getting the high even once in a blue moon are almost zero. So it's fruitless. You shouldn't even think of that. What you're trying to do is make a decent profit. Just make a profit and make more than you're risking, and do it as many times as you can that it's meaningful enough for you to be able to compound a nice big return at the end of a year. And here, very simply, I'll show you a way that I, played a recent trade. This is Shutterfly. We were actually talking about it today, David and I. It's now, this stock is topped and looking like a short, maybe. So it comes out of this power play here. Some people call it a flag. It comes off a little cheat area coming out. A lot of times these little flags, I'll buy them coming out of the cheat area. So I buy it here. It runs up, and I reduce my position, and then I move my stop to break even. So what's happening now is I'm pre-rolling the trade. I'm going to make money no matter what, unless it gaps down and gets this giant gap maybe on news. That's the only way I could lose money on this, and would have to gap quite a bit, because of course I've already nailed down a profit. Now, as it started to go through this basing period, I was actually going to add back to it and very often what I'll do is I'll trade around my position. So I'll trade out of some, it resets as it turns back up, I'll trade back in. So I hold part of it, I trade part of it. That's called trading around your position. But what happened was it gapped out. So instead of having the opportunity to buy it coming out, it got ahead of itself so quick that I actually just sold it and took the profit. So this is just a very typical way that I'll play a swing trade. Let's see. So this is another one recently, not too long ago, GTHX, where I bought it again. Very similar. You see almost the identical type of trade where it's a very high momentum, corrects, doesn't correct much, and as it comes through that low cheat, I start buying it. I sit through it as it consolidates. It runs up. I'm up 23%. I reduce the shares. I sell some of my position. Now I'm up almost 40%. I sell a little bit more. Now I start backstopping it, and it came back in where I was only up 22%, and I decided that's it, I'm out, and stock came in from there. But I just stuck to my original stop until here's Netflix. This is a recent trade in Netflix. So I bought Netflix. You can see it was putting in this base. If you'll notice, everything that I do has VCP. Okay, for those of you that understand VCP, you know exactly what I'm talking about. For those of you who don't, you should refer to my books and also to O'Neill's book about look at the coupled handles and look at what we're talking about and the characteristics that should happen while you're getting these price consolidations. You can look at charts going all the way back to the 1800s. Same thing, timeless. This is never going to change. It's simply the law of supply and demand on display. So I'm buying it here, right? It's coming out of this nice little tight area. We run up a bit, I reduce some. We run up some more, I sell it into this strength. So again, you see, I'm using strength. I'm almost always selling at the strength unless I'm being forced out and it's coming back in. Then I'm being forced out of the stock. But I don't want to give the stock a chance to break. I don't ever want to give the stock a chance to break. I want to get out when the getting's good, because what can happen is, like, say I wait here and I keep waiting and backs and say, well, let me see until it starts rolling over. And then look at here, wham. You give up all this ground in such a short period of time. You would have been better off selling it on this first rally phase and not even waiting. So a lot of times if you get out when the stock's up, you'll do better than if you use a moving average or something and wait for it to roll over and to have a trailing stop. So I'm always trying to sell into strength. Dave, are you, when you're at a profit, are you using strength for selling? Has that been part of your repertoire for a number of years?
Yes, at times when the stock is, and the thing about this stock is, if you can watch my pointer, it was going up at this angle, and then it started almost going straight up. When I have a stock that's going straight up like that, I watch it very, very carefully for signs of a top. And when I see a reversal on volume, or here it looks like it had an inside day and gap down, I do look to cut down the position. I don't want to lose the position because it's usually a very, very good stock, but I will cut it back, and I'll cut it back dramatically if it starts showing those signs of topping. Well, what this one did, it looked like it started building a whole new base again, did not break out, but actually broke down, and that's where the rest of the position, if I had owned this, would have been gone. But I look to see those signs of when something is getting very, very excessive, and there are some signs where we've had some technology stocks recently that have had those signs of excessive moves to the upside.
睇完佢嘅影片之後咧，你應該會對佢嘅方法咧有大概嘅理解，而其中佢提到佢所用嘅交易方法就係 Volatility Contraction Pattern， 簡稱 VCP， 中文解作波動收窄形態。咁 Mark 咧亦都提過咧 VCP 嘅概念咧係取自杯柄嘅形態嘅。顧名思義咧，呢個形態嘅原理係由大型嘅投資者慢慢咁樣買入小型投資者嘅股票，過程裏邊咧價格走勢嘅波動就會由大轉小。當需求越嚟越大嘅時候咧，價格就會急速上升。如果喺呢個時候買入股票嘅話咧，獲利嘅機會咧就係最高㗎。咁有見及此咧，我就根據 VCP 嘅特徵咧，嘗試喺 Multi Chart 裏邊寫咗一個 VCP 嘅程式。咁測試一下咧，能唔能夠喺股市裏邊賺錢？程式化嘅過程咧就係咁樣嘅。首先我就用我之前影片所提過嘅方法啦，先揾出價格走勢嘅頂部同埋底部嘅位置，再根據 VCP 嘅主要特徵，例如成個圖表形態係會持續向上咧，每次波幅嘅底部會越嚟越高， 波動由大轉小咁轉變，都可以咧描述為一個可以量化嘅數值嘅。咁然後就再將呢一個程式套用喺一堆股票上邊，就會得出以上嘅表現啦。咁如你所見呢， equity curve 咧都係持續咁向上嘅，代表呢一個交易方法咧都有一定捕捉趨勢嘅能力。咁如果你想了解更加多關於呢一個 VCP 嘅程式咧，都可以考慮訂閱我 Patreon 嘅內容啦。咁裏面會有更加詳細嘅解說㗎。希望你哋喜歡今日呢個影片啦，我哋下次再見，拜拜。